Today, I want to tell you about the number one most costly item when it comes to getting a home loan that people don't even realize. Welcome in, everybody. If you don't already know, my name is Aaron Page, and I have been a mortgage broker and a mortgage lender for over 14 years, operating out of the Pacific Northwest. One thing that I see when it comes to mortgages that's very common is an interest rate buy down. If I don't see it daily, I at least see it every other day. But most people, when they're looking at getting a mortgage, they don't actually understand how an interest rate buy down works because they're so hyper focused on the interest rate. And for some reason, I've never really understood why. I mean, I get it, like in the basic concept of the lower the interest rate, the lower your payment is. But some people get so hyper focused on, I need my interest rate to be X. And it's not even like it's a bragging point to your friends or anything. It's just they're so hyper focused that they don't care what it costs and they don't realize that they're losing money by doing so. So let me dig into this to try and explain it a little bit better so you guys understand what I'm talking about. In the United States, the average life of a home loan from the day you get it to the day that loan is either refinanced or you sell the house is 5 to 7 years. So for this example, we'll just use 5 years, which basically means if you choose to do a buy down on your interest rate, let's just say as a hypothetical, interest rates today are 7% and you want to buy down to 6.5%. You need to analyze what's it going to cost to go from 7% to 6.5%. How much are you saving per month? And what's the upfront cost to get there? Because if the average life of a loan is 5 years and you don't save your buy down costs within 5 years, you're literally losing money. So let's just look at this scenario. Let's say you're buying a house for $400,000. You're going to put 10% down. So you're going to have a $360,000 loan amount. And if you don't buy down your interest rate, it's going to be 7%. Again, it's hypothetical. That's not a guarantee or a commitment to lend or anything like that. There's my disclaimers. This is just for informational purposes. So a $400,000 purchase price, 10% down, a loan amount at $360,000 with an interest rate of 7% is going to give you a principal and interest only payment of on that mortgage of $2,395. Now, let's say to buy the interest rate down from 7% to 6.5% is a 1% cost or 1 point, which would be 1% of your loan amount. So in this scenario, 360,000 times 1%, the cost of the buy down would be $3,600. Now, a $360,000 loan amount at 6.5% is a monthly principal and interest payment of $2,275. So 7% is $2,395, 6.5% is $2,275. So you have a $120 per month savings. So with this exact scenario, with a $3,600 buy down and $120 a month in monthly savings, your break even point of how much money you're saving per month on your monthly mortgage divided by the cost of the actual interest rate buy down, you would recoup your savings in monthly interest in 2.5 years. So in this scenario, if you had the cash on hand or you had a large seller credit, the interest rate buy down actually would make sense because if the average life of a loan that we're using for this video is 5 years, the first 2.5 years, you're not really making money or saving money. You're just recouping your interest rate buy down from the beginning. But the remaining 2.5 years is nothing but savings for you every single month, month over month, until you decide to either sell the home or refinance that loan. Now, as an example, if the interest rate buy down to go from 7% to 6.5% was going to be 2% versus the 1% we use in this example, your break even point would actually be 5 years. So if we're keeping this loan for 5 years, but your break even point is 5 years, you're not saving any money. You might feel like you are, but you're not because the 2% up front would be $7,200. That's what you would save over a 5 year period. So you literally would just be spending $7,200 up front to give that money and essentially prepay the interest that you would have saved over the 5 years, but you're at a break even point at the end of that time period. The only time you would actually benefit would be if you kept your loan longer than 60 months or 5 years. Here are the 3 times when I would not even consider an interest rate buy down. And the first one would be if you know as soon as interest rates drop, you're going to refinance. It just simply doesn't make sense to take money out of your pocket if the minute interest rates drop a half a point, you're going to be jumping at the opportunity to refinance. A buy down will not make sense if you just know you're that kind of person that the minute you see rates drop, you're interested. I would hold off on an interest rate buy down. The second one is obvious. If you don't have the extra money, you don't need to go above and beyond to try and scrape this cash to just be able to buy down your interest rate. Chances are you're not going to see the full benefit of it because the average life of a loan being 5 to 7 years, I think, is pretty aggressive. The average life, really, in my opinion, is probably closer to 3 years with the way the interest rate market has been. It just seems to make sense that people are refinancing sooner versus later. And the third one is if you know you're not going to be in this home very long, you know it's a starter home that you're going to leapfrog into another new home here within 3 years, it just doesn't even make sense to do the buy down unless you have extra seller credits or your lender is giving you a credit to actually do it. But a lender credit for an interest rate buy down would be very rare. And then the reasons why I would do it is actually the complete opposite of what we just said. If you know you're staying in the home long term, then do it. If you're going to be there at least 10 years and you can get a recoup in monthly savings cost of 5 years or less, you're literally going to have an extra 5 to 7+ years of just savings. And that leads us into point number two is if you have the cash on hand to do that and you're going to be in the home long term, it just simply makes sense to do it and take the savings within reason. I would never ever suggest to anybody that they buy down their interest rate more than 2 points. The break even point on that, or just life in general happening, you never know. You could get relocated for work. Unfortunately, you could go through a divorce. It doesn't matter the scenario, but when life pops up, when you have more than 2 points invested into your loan, I just don't ever think that makes sense. It's too aggressive of a buy down. I want to thank you guys for watching the video today. Share this with anybody who you think might find it helpful or anybody who is looking to invest in real estate. And don't forget to like and subscribe.